Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video of US individual taxation applicable adjustment to gross income part 2, we are going to cover child support, compensatory and punitive damages, child care, tax-free dividend, gifts, group insurance, group life insurance or health saving account. So let's dive into to understand all such topics in detail. So far so good.
Yes, sir.
Next is compensatory and punitive damage received. So here, like for example, an employee is working in any manufacturing organization, right? And unfortunately, let's assume he or she has got injured, right? For any unforeseen situation when he or she is working in the manufacturing setup or maybe in any chemical reaction or any hazardous component because of that, right? At that point of time, if the employee has received any compensatory or punitive damage for that particular injury or that for that particular reason, so that at that particular time those are not considered as part of the income. But here is the catch also, like later on you will see the compensatory damage or punitive damage, I would say, like for example, anyone has lost their maybe hand or leg or maybe eyes or maybe any such like major disease has happened when he or she is working at the factory, right? So at that point of time, all the compensatory or punitive, which is one time amount he or she is receiving from employer, that is like like tax free, or I would say exempt. But later on, if he or she is getting any recurring money, right? So that recurring money is being taxable, but one time compensatory or punitive damages are exempt. That is the difference. So in future you will see like the compensatory or punitive damage, or you can say disability damage, or maybe disability allowance paid by employer to employee, which is like recurring in nature, that is considered as taxable income. But the for one time at the time of injury, if any such amount is being paid by employer to employee, for employee it is an exempt income. Make sense?
Sure.
Next is tax-free dividend. Same like in India also we have certain you can say stocks for which are being tax-free dividend. So that is not considered as part of income. Here is the interesting one. Gift. Right? Gift to any person up to $17,000. That means your taxpayer can give the gift to any person up to $17,000. So the person who is receiving the gift, he or she does not have to pay any taxes. Or the person who is paying gift, he or she also is not required to pay any tax on that. Second is US citizen spouse. That means the person who has a spouse who is a US citizen, right? So word here clearly mentioned is a US citizen. If you remember, we study on the residential status, right? In the residential status, we have studied three type of residents: US citizen, resident alien, and do you remember? Are you guys here with me?
Yes, sir. Yes.
What was the third one? Non-resident,
Non-resident.
right? So here the word clearly mentioned US citizen. That means it does not cover non-resident alien or resident alien. Only the US citizen spouse, right? So to US citizen spouse, the taxpayer can give gift unlimited, right? There's no money limit to it. Third is foreign spouse. That means if any United States citizen or resident alien, right, have any spouse outside the United States of America, right, he or she can give up to $175,000 per annum, right? This all limit is per annum. First, second, and third, which you have discussed, is per annum. But the fourth one is lifetime gift. That means once in your lifetime, you can give the gift up to $12.92 million if you are single or married filing separately, or if you are married filing jointly, it is $25.84 million, right?
Okay.
So up to this limit, those gift is not taxable, neither the person who is providing nor the person who is receiving. Make sense?
Yes, I think that's the best way to.
Yeah. Transfer the money. Yes, very true. If you see, like the foreign spouse, 175,000 every year you can, transfer as a gift, huge
Wow.
amount, right? And lifetime, if you are like joint filer, 25, almost $26 million. It's a huge money,
Right.
right? So there you can do like a lot of tax planning to for your clients also, for providing the gift. Like 17,000 you can give to any person. If you give to 10%, it is 170,000, right? So that is also, like you can think of doing tax planning
So
around it.
foreign spouse means spouse staying out of United States or a spouse for another nation but staying in US with not a
Yeah,
citizenship.
yeah. No, two things here. Uh, if you remember when we study the residential status, resident alien include if you have married, if the taxpayer has married to the US
Citizen.
citizen, he is considered as resident alien, right? So if the
Yeah.
spouse is being married with the US citizen, then spouse is automatically a resident alien. So this is about foreign spouse outside the United States of America.
Okay.
Mhm. Wealth is group life insurance up to the coverage of $50,000 paid by employers, right? So, which, like in India also we do, like I think 3 lakh is the limit medical, right? 13 is with the limit, within limits, employer contribute to a health, before that, sorry, 12th point, I would reiterate again, sorry, yeah, this is very important. Group life insurance up to the coverage of $50,000 paid by employer, right? You will see there would be like many question you will experience when you start doing practice, that employer for executive they have paid the premium for $100,000 coverage, right? Then in that case of scenario, up to $50,000 coverage is exempt, but over and above what they are paying premium, that is taxable, right? For example, if you can, do you guys have notepad and pen with you by any chance?
Yes, sir.
Can we write an illustration quickly, small illustration?
Yeah.
Hmm. So, for example, Mr. X is an executive. Mr. X is an executive in Google, and Google provide $100,000, $100,000 life insurance coverage to Mr. X. Life insurance coverage to Mr. X. How much income will be taxable in the hand of Mr. X if if the insurance premium if the insurance premium for $50,000 coverage coverage is equal to $1,000, $1,000, comma, life insurance coverage up to $100,000, up to $100,000 is $1,500, and life insurance coverage life insurance coverage of $200,000, $200,000 is $2,200, $2,200, right? So call of the question is how much amount is being taxable in the hand of Mr. X, right? So
Five
sorry,
$500, sir.
yeah, yes, very so. So like for $100,000 coverage, the premium is $1,500, right? But for $50,000 coverage, the premium is $1,000. So difference is $500, right? So this $500 is my taxable income, but first $1,000 is not taxable income. Clear?
Yes.
Hmm. Okay. So this is about group life insurance coverage. Next is within limits employer contribution to health saving account. So if employer is making contribution to a health saving account is basically a check-in account where employee or employer can make their contribution and that money can be utilized only for healthcare expenses, not for any other expenses, right? So at the beginning of the year, both employer and employee make certain contribution to health saving account, and during the year, whatever the health related expense that individual might have incurred